All right, so tonight we have a timely subject and a very special guest that has crafted her presentation specifically for STLREIA, Real Estate Taxation and How to Master It as an Investor. Whether you operate your business as a sole proprietor or a real estate LLC, you better operate correctly. We will be gaining valuable insight on some unique tax benefits, understanding liability, as well as potential deductions. We'll also be finding out about what top software solutions you should be using to track your expenses and simplify your processes. Our special guest tonight is a senior manager with Anders CPAs and Investors. Anders has over 55 years of service and is passionate about servicing you, the investor. Please give a warm welcome to CPA Ms. Elizabeth Watkins.
Thank you. Good evening. Can everyone hear me? Is this okay? All right. Well, as mentioned, my name is Elizabeth Watkins. I'm a senior manager with Anders. We're located downtown. We also have an office out in Chesterfield now, which is exciting. And I am here this evening to talk tax law with you as regards to your real estate investing activities. So first up is a bit of an agenda. These are some of the topics that I thought of as I was thinking what might be of interest to you. So discussing what makes for passive activities, talking about the tests needed to qualify as a real estate professional, the tests that you have to pass to establish material participation, owning your real estate, how best to own the real estate, briefly touch on some of the software programs for managing and tracking your activity, and then lastly, just a few quick 2024 tax updates, because I can't give a presentation at this time of the year without talking about tax updates. All right, so first up, I'm going to discuss what makes for passive activities. In general, when talking about real estate activity, real estate investing, the IRS kind of defaults to treating these activities as passive, which means that any of your losses incurred are going to be limited. A passive activity is an activity in which you do not materially participate. As mentioned, I'll be discussing the tests that you need to hit to make material participation, but just know that if you do not materially participate, then your involvement in your real estate is going to be considered passive. And then the one other caveat here is for limited partnership interests. I know some of you might own your real estate through LLCs that have multiple members, and so typically those are taxed as partnerships. If your ownership is marked as a limited partnership interest, then your default is passive treatment on the activity that flows from there. So I just wanted to bring that up. As I mentioned, passive activity losses are not just something you can deduct full out the year that they're incurred. You are at first limited to any passive activity income. So passive activity income might be things like interest and dividends, of course, income from other rental activities that you have, but you can't just fully deduct losses in the year that they're incurred. You're going to be limited to the income that you've earned from other passive activity. Certain taxpayers, though, can deduct up to $25,000 of passive losses, and this is specifically for real estate activities. So that's good news for you all on that front. Thankfully, if you do incur losses that you're unable to deduct in the current year, they're not just gone. They're simply suspended, and those losses are carried forward to future years when you do have passive income to offset them with. Now, the nice thing is that in the year that you might dispose of or liquidate an activity, you can fully deduct all of those suspended losses. So you sell a property or you liquidate your interest in the property, any losses that have built up over the years that you've been unable to deduct, you can fully deduct in that year of disposition. So you would get to deduct any of the current year losses that you've incurred, and then also all of those prior year suspended losses. So I had mentioned that there is a special allowance for deducting up to $25,000 of a loss from a rental activity. So now I just want to cover the rules around that special allowance. In order to be eligible for this, the taxpayer or the spouse must actively participate in the rental activity. This means that the taxpayer or their spouse has to own at least 10% of the rental activity or the rental property, and then you have active participation. And the rules are a little different from active participation from material participation. And some of the things that the IRS outlines as regards to active participation are that you're making management decisions, you're approving new tenants, you're approving the rental terms or the lease terms, you're the one arranging for the repairs or any of the capital improvements. That would meet active participation as regards this special allowance. When calculating how much of the $25,000 you can deduct, you first net all of the income and losses from any rental activities in which you have active participation. So let's say in any given year, you've got a $10,000 of income from one in which you actively participate, and you have a $15,000 loss in another property. The net that you'll be able to deduct is $5,000. If we change the facts of that little example, you have $10,000 of income and let's say $40,000 of loss on another, well, you'll net those at a net $30,000 loss. You only get to deduct up to $25,000, and then the rest of the $5,000 is suspended and carried forward to future years. Now, the other caveat with this allowance is that, of course, the IRS thinks that if you make too much money, you shouldn't be allowed this deduction at all. So if your adjusted gross income is anywhere between $100,000 or $150,000, the loss is limited and then completely gone. And I'm sure you all are aware, but adjusted gross income, you're looking at other sources of earnings as well. So any wages, any income you might be earning from self-employment or if you own an S corporation, things like that. That's what's going to help make up adjusted gross income. Any questions so far? Next, I wanted to touch on some of the requirements to being considered a real estate professional. Because, kind of as we were mentioning before, the default treatment for rental activity is passive, and so you don't get necessarily all of the benefits if some of your properties are accumulating a lot of losses. So one of the designations available to you is to be considered a real estate professional. And this can, of course, have a considerable impact because it might allow you to deduct some of those losses beyond that special allowance. In order to qualify as a real estate professional, the IRS has two tests that you have to meet. It's a both and. So you have to meet both of the stipulations in order to have this designation. And these are that the taxpayer must perform more than 50% of their services in a real property trade or business in which they materially participate. This means that 50% of your time needs to be spent on real estate activities. The second test is that the taxpayer must perform more than 750 hours of service in real property trades or business in which they materially participate. So types of services that you might be performing are real property development or redevelopment, construction, reconstruction, acquisition, your rental, operation, management, leasing, or brokerage trader businesses. Something to note is that you don't actually have to have a license or a certificate to be considered a real estate professional, so you don't have to have your real estate license in order to be considered a real estate professional. Something to note with this is that any services you perform as an employee in a real estate trade or business, so you work for a real estate firm or a brokerage, those services as an employee do not count towards this 750 hours. Those 750 hours have to be separate from that, from your services as an employee, unless you're a 5% owner of that company. So if you own a brokerage or you own a real estate firm, then those services and those hours count. If you don't have ownership though, they do not count, and you're gonna have to keep a separate log, separate records for the time that you're spending towards real estate activities. All right, next up is, so a lot of the, oh, yes. Yes. Yes, yes, so the question was, if you're a regular W-2 employee, kind of a standard 9-to-5 job, and do those hours count towards the overall 50% of your time being spent in real estate activities? And yes, they do. So it's gonna look at how do you, as an income earning taxpayer, spend your time. Is more than 50% in real estate, or is more than 50%, say, as an engineer or a teacher or an accountant? Or so yes, the IRS looks at all of your time for the year. Yes. Yes. Is that hours for the person or for one LLC? That's the person. Yes. Yeah. Doesn't matter how many LLC you have. Right. Yes. The rules we're going to cover on material participation are looked at by property, but to obtain this real estate professional kind of designation, that's total hours, or global hours, if you will. It averages to about 14 or 15 a week, because the IRS, when they say more than, they mean 751. And like I said, yeah, about 14 to 15 hours a week are spent on activities that, like I said, real property development, things like that, rentals. Okay. So material participation came up quite a bit in the tests that are you need to hit in order to be considered a real estate professional. So what does the IRS mean by material participation? Again, just want to reiterate, because it can have a significant impact on your tax situation. Because if you materially participate, you may be able to deduct more of the losses that could be accumulating in your properties. The other nice thing is that with material participation, your rental income, rental activity would not be subject to the net investment income tax, which is an additional 3.8% tax on investment income. And then the IRS has 7 tests that you have to look at in order to make material participation. The nice thing is that you only have to hit one of these 7. With the real estate professional, you had to hit both, but with material participation, it's just one of the 7. And I will be honest, I do not have these memorized because they can be meaty, if you will. So here they all are. I think you'll be getting a copy of these slides or this presentation afterwards, so you'll have this to reference. But the 7 tests are that you participated in the activity for more than 500 hours, or your participation was substantially all the participation in the activity of all the individuals for the year, including an individual who doesn't own any interest in the activity. So you hire a property manager. You still have to provide substantially more time than they do working or managing the property. Another of the tests is that you participated more than 100 hours, and you participated at least as much as any other individual. So again, someone like a property manager. The activity is a significant participation activity, and you participated for more than 500 hours. Another of the tests is that you materially participated in the activity for any 5 of the 10 immediately preceding years. Those 5 years do not have to be consecutive, which is nice. The 6th test is that the activity is a personal service activity in which you materially participated for any 3 preceding years. And then lastly, based on all of the facts and circumstances of your situation, you participated in the activity on a regular, continuous, and substantial basis during the year. I will say that it's a good tip to keep keep logs of all of your time and of all of the work that you're doing towards these properties. When the IRS questions material participation or questions that a real estate activity has been marked as non-passive and so losses were taken, one of the things that they're going to ask is proof of material participation. And usually, if you keep some kind of log book of your hours, if you keep a mileage log, you have properties all over the city and you can show I was going here and there and everywhere, addressing tenant concerns or managing the properties, overseeing repairs, capital improvements, that sort of thing. It's always just best practice to keep very detailed records in order to prove basically material participation. One of the things to note about material participation is that participation in managing the activity doesn't count in determining whether you meet the tests if one or more of these following tests apply. So if someone other than yourself received compensation for managing the property, or an individual spent more hours during the year managing the property than you did. And then finally, as I mentioned before, with real estate professionals, real estate salespeople can't count your hours worked as a salesperson with your rental real estate activities for the purposes of determining material participation. So again, your hours spent as an employee of a brokerage or a RE/MAX or something like that don't count towards the hours needed to hit material participation for any given activity or any given property.
So, in that case, my wife does a lot of the work. I do the grunt work. So, at 750 hours, again, a combination of her hours and my hours together, 750, is that okay?
It is for material participation, yes. So yes, a taxpayer and a spouse can group their time worked on a property in order to meet these tests. So yes, your wife spends 200 hours, you spend 301, together you hit the 500, you then meet the tests required for material participation Yes.
Just to clarify, the real estate professional test is separate from the material participation test. So you as an individual, when you look at 730 hours, you consider the real estate professional to conduct all the losses, similar to the other business with losses. It is for
You know, you gotta join return.
that's per person. You or your spouse to be a real estate professional, you have tax. Material participation hours is completely separate. A lot of times there's a misconception that if I'm a real estate professional, I can deduct all of my losses, and that's really not accurate. Especially because you still have to meet these material participation tests to even qualify these, to be real estate. It does, yeah, so it goes back to the $25,000 deduction.
Yes, yes, so, yeah, yeah.
It's not exactly the same. It's still limited to
Right.
It's free.
Yeah,
They don't make
yes.
it easy.
Yeah. Did everyone catch that?
I would say that on Zoom, but people do.
Sure, so the tests to be considered a real estate professional are separate from the tests needed to make material participation. And just because you meet the tests to be considered a real estate professional does not mean you've met the test to make for material participation, which would allow you to deduct, up to $25,000 of losses or, yeah. Is that? Yes.
Wait a second, with questions, can we use the mic so we can
Oh,
hear
yes.
all?
Yeah, about 90% of the people are at home right now and don't need to do a conversation for a while.
Yeah, so, if you don't mind,
We can
yeah.
either hold questions until the end, if they're like, they need the conversation at the end. Hang out.
Okay. Sure.
I was just gonna ask, if we had one property that was worth $100,000 and our rent is, $1,000 a month, are we gonna be able to take advantage of any of this, or do we have to be at a certain threshold in order to start taking advantage of the losses and the different things?
Sure. You do not have to be at a certain threshold. The property doesn't have to be valued at a certain fair market value, and the rents don't have to be a certain dollar amount. It's really your time it's basically your time and your energy spent.
So there's a scenario where I could take $25,000 in losses on my one rental property.
I mean, if you've actually incurred $25,000 of losses,
How
so
could I do that?
you're. I don't know that I can give an opinion on that necessarily, but
Okay.
yeah, $1,000 a month in rent, $12,000 of revenue for the year. And after real estate taxes, maybe your mortgage interest, you had to replace the HVAC, you were covering utilities. I mean, you could, insurance, lawn care. I mean, there are absolutely scenarios where you would quickly rack up more expenses than the income that you're generating. And so, yeah, I mean.
So it's
Yeah.
possible, in which case I would want to meet these standards so that I could take those losses
Correct.
instead of it just being a hobby.
Right, and limited to the income that it's generated. So in that scenario, if you don't meet these tests, then you're gonna be at a net zero from a tax perspective. You generated $12,000 of income, so you can only deduct up to $12,000 of expenses. And then any additional expenses are what we call suspended. You can't, they're just lost for the current year, and then they roll forward as a carry forward for future years.
But I'm not gonna make any more off of it because I'll be in the same boat next year.
Right, yeah.
Okay,
Mm-hmm.
all right, thank you.
This is a quick one, I think it's relevant here though. Is there a limit on amount you can carry forward? I thought there was, per year.
No,
No.
not from, yeah.
Wasn't there something at one time, there was a $3,000 limit?
That's capital
That's
losses.
capital losses.
Yeah, capital losses, you can claim, well, you can only claim up to $3,000 of capital losses, anything can carry forward. Yeah. Okay. So next I wanted to cover some ideas around how to own your real estate, whether through LLCs or individually or directly, as we say. So this first option is just if you're going to own your property outright. To the IRS, they would call this a sole proprietorship, basically. You own it just through your name, your social. You're the sole owner, so of course, that then gives you all of the management rights, all the management decisions. You're the one, you have 100% control over how that property is run, who you rent it to, any improvements that are made, how long you hold it, when you sell it, things like that. The downfall is that, yes, you're not as well shielded from liability should anything happen to someone on the property and they go to sue you. It's you individually who are going to be on the hook. One of the benefits of owning real estate is that you might qualify for the 20% qualified business income deduction. I'm going to talk about that a little later on, but just know that this deduction is out there for you at this time if you do own property as a sole proprietorship. The next option is to own your real estate through what we would call a limited liability company, or for short, an LLC. This does just what the name suggests. It is a nice buffer or kind of a hedge of protection around you should anything happen. It's a limit on your liability. Now, an LLC can still be run as just you with a single owner. We would call that a single member LLC. There's no real change from a tax perspective if you own the property outright as a sole proprietor or if you own it through an LLC. Both types of ownership result in the same tax on your individual return. There's no separate tax filing to be a single member LLC. Everything just goes right on your return the same way it would if you were just operating as a sole proprietor. An LLC, though, does allow you the benefit of bringing on other investors or coming together with a pool of people and investing in real estate. Those would be multi-member LLCs. And the default tax designation is going to be as a partnership, and that is always what we recommend. We would not recommend owning real estate through like an S corporation or a C corporation. It just gets very difficult to get the property out of the entity later on, or the taxation becomes a lot more cumbersome, if you will. And so if you have a multi-member LLC, as I said, it will be taxed as a partnership. You would have to file a separate tax return, a partnership return on a Form 1065, and then your pro rata share of that activity comes to you on a Schedule K-1, and then that Schedule K-1 is what gets reported on your individual return. Another type of ownership structure, is to use almost like a holding company, if you will, for your rental properties. You can set up an LLC that can kind of be the master LLC, the big umbrella, and then you could set up other LLCs that are owned by that umbrella, and so each property is separated out to again help with shielding of the liability between the properties. So that's always an option as well. You can have as many single member LLCs as you want for all of your various properties, and then either own all of those single member LLCs outright or own those through, like I said, kind of an umbrella holding company. It really just depends on what's best for your situation, how extensive are your real estate holdings, what type of real estate are you operating? Is it a commercial property? Is it an apartment complex? Is it condos, short-term rentals, smaller, just single-family homes? It kind of just depends, and so we always recommend, working with an attorney or your accountant to figure out really what's best for your situation with regards to sole proprietorship or an LLC, and then how to really structure that LLC. And then again, if you have all of your property through an LLC, this too can qualify for that 20% qualified business income deduction. So I wanted to just take a few moments to discuss this. You all, hopefully you're aware of what this is. The qualified business income deduction was enacted with the Tax Cuts and Jobs Act, and it is a 20% deduction on qualifying business income for the tax years 2018 through 2025. When the top corporate tax rate was reduced from 35% down to 21%, this business deduction was introduced to sort of level the playing field, because all of a sudden it looked a whole lot nicer to operate a C corporation than it had in the past. So that's kind of the why behind this deduction. And it is, like I said, a 20% deduction on income from a qualified trade or business. Generally speaking, the IRS says that real estate meets the test to be a qualified trade or business. The tests for this particular deduction are separate from the test for material participation, separate from the test of real estate professionals. So just know that. So even if you don't meet material participation or you don't meet the test for a real estate professional, you can still meet the test for your rental activity to be considered a qualifying trade or business for the purposes of this deduction and take advantage of this deduction. So in order to meet the tests, the IRS says that your rental activity, or that you as the taxpayer have to be involved in your rental activity on a regular and continuous basis. And they have kind of three broad categories for what that looks like. So what are your efforts to rent the property? Is it available for rent, or does it just sit vacant? And then as the taxpayer, or do you have an agent who's maintaining or repairing the property? So again, you can hire contractors. It's not that you have to do the repairs yourself. You can have a property manager helping facilitate all of those things. Doesn't necessarily have to be you. And then yes, your management of the property. And then there is a safe harbor for real estate enterprises. So if you have a group of properties, does the group meet the tests to be considered a qualified trade or business for the purposes of this deduction? One thing to note is that there are certain types of properties that just don't qualify for this deduction. So if you've got a property under a triple net lease, or you're renting out part of your residence, your personal residence, let's say you have a vacation home in Florida or something. And then if any part of your real estate interest is treated as a specified service trade or business, I'm not going to go into the rules around that. Just know that that is a separate test, and it might disqualify your rental activity from this deduction. And then, of course, there are limitations. The 20% deduction is limited to 20% of your overall taxable income. So that's after factoring in all of your standard or itemized deductions, all of your other sources of income, things like that. And then, of course, there's a phase out, and it depends on your filing status, and it's indexed for inflation every year. And then once you hit that phase out range, there might be other things that you have to look at with calculating this deduction, any wages paid, or the basis of your property. Those are all gonna come into play with regards to this 20% deduction. And then any prior year losses on the property have to be netted with current year income in order to calculate the 20% deduction. Just know that kind of broadly, there is this 20% deduction for qualified business income, but then, of course, different tests, different limitations, things like that to keep in mind for your planning. Questions?
Elizabeth, in your experience at your firm, with rental property, how many people have the sole proprietary, you know what I'm saying?
Yes, operate as
Versus
a
the-
sole proprietorship.
Proprietorship versus LLC. Are most people doing the LLCs? Or do you find, because I would see that, I'd be concerned not having the LLC part because of the liability, or lack of liability protection, but if they're, so what are they doing, or why are they doing it at all,
Sure.
not just going straight with the LLC?
Right. Yes, I would say most often I see that property is held through an LLC. If it's not, it's maybe because they're just getting started and maybe they haven't considered it yet, or they just hadn't, their activity isn't substantial enough that it would warrant an LLC. In that case, I'm thinking of somebody who, maybe it was the condo that they bought, it was their first home, kind of a condo or something, and they decided to keep it and rent it, and they purchased a new main home, something like that, where it's just much smaller and they're just getting going. But no, the larger, more extensive real estate investors that we see do have LLCs, and then there's kind of, their properties are broken out amongst multiple LLCs, again, to separate from a legal perspective, to keep the activity separate, not necessarily from a tax perspective to keep it all separate, but at least legally and for liability purposes.
Can you go back one slide real quick? What is a triple net lease property?
Yes. So, oh goodness, this is Jean, might need your help. Yeah. Just to make sure I don't get that. Yeah. I can. Yeah.
Yeah, so a triple net lease is commonly whenever a corporation or a business owns its own real estate. So maybe you have a business that you operate out of the building that you also own, but you own them in two different entity structures. So when you have a triple net lease, your operating entity is the one that's usually responsible for paying real estate taxes, insurance, general maintenance and upkeep. So really all that's happening is the landlord, your other entity, is just essentially collecting a rent check. And so it's really all the operational, the quote unquote business component of the real estate is really outside of the entity that's owning the real estate. In that case, the income, you can't shift a bunch of rental income over to your LLC to generate a really attractive deduction with this QBI because it doesn't qualify. Another scenario that we see commonly is if our operating entity is a C Corp. C corporations, because they're at a flat 21% tax rate, do not qualify for this QBI deduction. And when you're in that situation, if you're renting to a C corporation entity, you automatically are disqualified from the QBI deduction as well. Does that answer your question? Yeah.
I have a few questions on the
LLC. One of them is if you have an LLC and a husband or wife own it together, is that a partnership?
Not necessarily. It could qualify as, it's what's called a qualified joint venture. And so it wouldn't need a separate partnership filing. And that would, if they're married, now they have to be a married filing joint tax return. And so you could just report that on their individual return. There's a box that you check, or you have to, but then otherwise, no, you don't necessarily need to file a separate return.
Okay. Another question in that line, as far as 1099s and LLCs, do you need to send, if a company is an LLC, do you need to send them a 1099?
It depends on how they're taxed. So a single member LLC, yes. An LLC being taxed as a partnership, yes. If the LLC made an S election and is being taxed as an S corporation, then no. LLCs can also make elections to be taxed as C corporations, and so no, that one wouldn't need a 1099 as well. So kind of whenever you receive the W-9 from the LLC that you've been paying, they have to indicate to you how they're taxed. And so that would then help you make the determination for whether or not to send a 1099.
So for a partnership, then on that checklist, then they should
Mark,
receive it.
yeah. Mm-hmm.
But if there's, and if it's a single member also, then they need to get it even though they're taxed as an S corporation?
Well, so you can be a single member LLC and still operate as a as a sole proprietorship. You don't make any sort of S election in that situation. But if the LLC has made an S election, then yes, because then it's a corporation, and so it's required to receive. I'm sorry, it's not required to receive a 1099. I got that backwards. Once you're considered a corporation, you don't have to receive a 1099. So S corporations and C corporations don't need to be issued 1099s.
Okay.
But a single member LLC that just operates more like a sole proprietorship for tax purposes does need to receive one.
Okay,
Mm-hmm.
gotcha. Okay.
Yeah. Mm-hmm.
Well, I was running around trying to get all these contractors, to do, and the part about, the way I understood, if you're an S or C corp, you don't have to worry about that. And that's what I'm hearing from you, right? Yeah. But if you are not an S or C corp, then you do have to worry about it, but it's only if you pay them more than $650 for the year. So if it's under 600, I think that's right, number 600.
600.
Right, if we pay them under 600, we do not have to worry about a 1099. Is that correct?
Correct. Yes.
Okay, and I know a lot of people aren't doing that, but
yeah,
the whole thing about the 1099s, or these guys that are running around that aren't S or C corps, are just Joe Blow. I do painting,
Mm-hmm.
but then you deduct $2,000 you paid this painter.
Mm-hmm.
Have you seen the IRS come back on anybody yet for that kind of, and not have the paperwork, or you have?
Yes.
You have seen it. And then disallow I think a lot of investors are missing the boat on that particular point. A lot of investors.
Those are called matching notices, if you will. It's one way that they're calculated.
I'll just chime in on this. I view 1099s as kind of a banana. Nobody wants it, but you just gotta have it. If you're doing the right thing and you're at least trying to obtain the information, collecting the W-9 before you issue the contract or whoever the vendor is their last payment, that's oftentimes your leverage. So tracking that, maintaining the W-9s, doing your due diligence, as long as you're trying your best to file the 1099s, there is a checkbox on your return that we're required to say yes or no, we were required to file 1099s, yes or no, we did or didn't file them. And I have been through many audits where as long as you're doing your due diligence on that front, they're not gonna go down your general ledger and look for any outliers. If you paid somebody $150,000 and you haven't 1099 them, that may come into play during the audit. But I will tell you, I don't want anybody to lose sleep over not being able to issue, because I've had many clients where they're like, John Smith just will not give me his social security number because he does not want to pay income on this. You can't force the hand on it. So all you can do is your best due diligence on that.
So next, I just wanted to touch on a few programs that are out there for tracking and helping to manage your real estate activities. Excuse me, these are some of the, I guess, the more prominent ones that I see. These are all have online platforms, helping collect revenue, linking to your bank account, linking to your credit cards, and then tracking expenses as well. We always let our clients decide which program works best for their situation. I would say that most often I see QuickBooks Online. Yardi, that one there at the bottom, I see with a lot of bigger operations, because Yardi is very helpful for tracking multiple investors across multiple types of properties. So that's really a pretty robust program. But these are just a few of the other options out there that you can subscribe to. I would say that, again, it kind of just depends on where you are with your real estate investing. I have some clients who, it's actually a mix. They'll send me their QuickBooks Online financials, and then they also send me spreadsheets. So it really just depends on what is best for your situation. Regardless, I would recommend that you have separate bank accounts for your real estate activity, that it's not all running through your personal checking account, or you're not running everything through personal credit cards. It just makes the record keeping very difficult and onerous. And then, you know, a separate bank account for every single property is certainly incredible, but I realize that's not necessarily feasible. So it really is just a matter of what's best for your situation, and then, like I said, just making sure that you can keep clean records, especially if the IRS ever questions your return, pulls it for audit. It's going to be so much easier to provide them the documentation and substantiation they're asking for when they want to know, you know, what proof do you have that you actually incurred this expense. You can just hand over your rental real estate LLC checking account statement and say it's right here. So yeah, if you aren't quite ready yet to use, you know, a platform such as one of these, then I just would recommend at least having separate bank accounts, separate credit cards, things like that, so that you can keep track and keep really clean records. Again, yeah, man, it's funny because the two I see most often I put at the bottom. So, but yeah, oh, so yeah, sure. Quicken, FreshBooks, NetSuite, Sage Accounting, QuickBooks Online, Accountant, which QuickBooks Online has a lot of different options, and then Yardi is the very last one. Yeah, QuickBooks Online is the one we most often see, and you can tailor QuickBooks Online. It's kind of, you can start with the smallest, if you will, and sort of graduate up to what you need as your activity grows and as your needs grow. But yeah, QuickBooks Online is the most common. Because it's cloud-based, and it's pretty user-friendly, just with the reporting, the connectivity to your bank accounts, dumping in transactions. I think it's just kind of the modern, sort of like coming into the, current times, if you will, going cloud-based, things like that. It's easy to allow access to multiple users. I know I just find that QuickBooks Desktop anymore to be a little bit more clunky. At least from an accountant standpoint, it's a little bit more difficult to share the file, to make changes on our end and then get them back to the client, whereas QuickBooks Online is more, at least from our, more real time. As many, the question was why QuickBooks Online versus QuickBooks Desktop? That was the first question. And then how many entities can you have? As many as you need. You can classify properties within QuickBooks Online. I've got a client, within the one login, they have, I don't even know, 5, 6 properties within there, and they've created different classes, and so you can isolate each property if necessary. I don't know, Jane, you've seen more of it.
Well, I was just gonna say, because when we started, back in 2018, 2016, something like that, we had on the desktop version, and they said you can go to online, but every entity would have to have their own login, and at that point, it was gonna be like you're paying the same price over and over and over again. So we said, no, we'll just keep using desktop. So to hear that you can view all the different entities together online is news to us.
Through the one login.
You can have one login for multiple entities, but each entity you have to pay separate membership. Yeah, I have one login for 2 LLCs. Each LLC you have to pay membership, monthly membership, separate. But one login also.
Yes, so when I was mentioning the classes before, that's one LLC, if you will, but then, the LLC owns 4 or 5 properties, and you can have the different classes underneath the one LLC. I don't know if that makes sense.
So if you have multiple bank accounts set up, you can have them all within one QuickBooks file, so you pay that one monthly charge. But then as long as you're at a certain level within QuickBooks, and I apologize because I don't know the exact tier that it puts you in, you can turn on classes. And with classes, you can set up property A and property B. Property A is only operating out of checking account 1, and property B is only operating out of checking account 2. You can have all of that activity with one QuickBooks file. So one, say $45 a month charge. What you're talking about over there is you have different LLCs set up. So you've set up a separate QuickBooks file. You've got $40 times 2 for that situation. You can do it either or. There's no requirement from us, from the IRS, from anybody, you have to have it in a separate account. It's really how it works best for you. I kind of think of it as one Excel spreadsheet, or do you have a separate tab for each company? With QuickBooks, that's the nice thing about online or even desktop, is you can have multiple real estate activities in one file if you want to. It just takes due diligence, because I always think QuickBooks is crap in, crap out. You don't take the time to put it in, you're not going to get a report out.
Make you more exposed because all your stuff is in one pocket.
Not necessarily, as long as you're tracking it by property, again, using those classes, you can run a P&L for property 1 and property 2 very easily out of there. It doesn't expose you anymore to the IRS. You're still gonna have to provide them with reports, so as long as your reports are supportable with your documentation, like that. And I will say, QuickBooks Online, they're forcing you to eventually.
That last comment was just to say that eventually it will all be QuickBooks Online.
I was just, that was part of my question I was gonna ask, because we get asked here a lot, having multiple bank accounts, does it necessarily matter? I don't know, like I said, we get asked, and some people say, every property of mine, I have a specific bank account, 10 bank accounts for each, or 1 bank account for each property.
I don't understand why, but some people do.
Yeah, I don't think it doesn't, as Jane mentioned, it doesn't, expose you to more risk to have that, to have multiple bank accounts. Yeah, it probably is a lot more overhead, a lot more time and energy on your part, but yeah.
I would just say, don't commingle personal with business or personal with rental. So I have gone through some audits where they didn't always use separate bank accounts. And so then what happened during those IRS audits is they looked at every single deposit in both the real estate account and the personal account and questioned it to the point that they had to provide a lot of documentation. So it was just very expensive for this client in particular because they didn't do the tracking, they didn't have it like they thought they had QuickBooks, but they weren't even using it right. So it was just very messy. So I think if you want to have one account, that's fine. Just keep it tracked, and most importantly, you want to know what your income and losses are by property. If you sell the house, if you want to suspend the losses, if you're not tracking, you don't know. But that's the most important. Whether you have one bank account or 13, it really is.
And then the last slide here, or last topic here, is just a few to touch on some 2024 tax updates. For the last few years, we've been enjoying 100% bonus or special depreciation on qualified property with the Tax Cuts and Jobs Act of 2017. Well, in 23, that 100% deduction phased to 80%, and then in 24 it will be 60%, and then the remaining depreciable basis is, the remaining basis is depreciated straight line over the useful life of the property. So just know that qualifying property bonus is going down to 60% this year. The standard mileage rate in 2024 is 67 cents per mile. I can imagine some of you are going all over the region to manage your properties, to oversee your properties. So be sure to keep good records of the mileage that you're incurring, because you're eligible for a 67% or 67-cent deduction per mile. And then not necessarily specific to real estate investors, but in 2024, the traditional and Roth IRA contribution limits of $7,000, those were increased for inflation. And then same with health savings account contributions. This is just a nice another little way to save some money, save some tax dollars if you're eligible, if you have a high deductible health plan at your disposal. We always recommend opening HSA accounts and putting away money for health expenses, healthcare expenses. So if it's just you on the health plan in 24, you can contribute $41.50, and if you have family coverage, which is just you and your spouse or you and one dependent, you can contribute up to $8,300. So just a few little tax updates for you. Other than that, any last questions? Yes.
On the mileage, what if you just, you have your truck and that you use it strictly for your real estate? And you just write down the mileage at the beginning and at the end of the year and say, this is how many miles I drove?
Yes.
We're good.
Yes.
That's what we do.
Yep. It's usually the IRS comes back to question the mileage deduction, and recreating that mileage log is a process. So that's why we all, but no, what you're doing works as well.
I go back to when you did the LLC structure.
Mm-hmm.
Do you see people using and trusting the concept in Missouri of a series LLC, having the master and then a series under it, or do you really have a separate LLC created, with Secretary of State for each of the LLCs under the master LLC? So I guess the question is, are series LLCs being used, and are they okay?
I do.
Yeah, but most commonly you see a separate LLC set up for each entity, and really, I think the underlying reason for that is the attorneys that they work with. Because when you're setting up your LLC, you should really be going through your attorney. So I think consulting the advice of it. And I don't see a problem with this series either. There's 2023, that means property was acquired that year?
Well, placed in service in the, if the property was placed in service in 2023, the qualifying property, if it was placed in service. So you might be working on a property and it hasn't been placed in service just yet, so you can't start depreciation until you place the property in service. You're actively trying to rent it, or you have a renter in there. But, yeah, does that answer? On qualifying property, it depends on what kind of property you have. So, yeah, qualifying property. Sure, so in general, a single family residence, the building itself, the home itself is not gonna qualify for this bonus depreciation. That requires depreciation over 27 and a half years, straight line, over 27 and a half years. It's different components within your home that might qualify. Let's say you bought new appliances for the home, or you had to do some improvements to the home. Trying to think of what else. It escapes me, all kinds of different things. Yeah, the driveway, things like that. But the building, the home itself, the structure itself does not qualify for this bonus. Question in from online.
Got a couple of them online here.
John, you're gonna have to walk away from this.
Does IRS consider a 40-hour work week pertinent here, or can one work part-time and still meet percentages when applicable?
Can you repeat that one more time? A 40-hour work week?
Does IRS consider a 40-hour work week pertinent here, or can one work part-time and still meet percentages when applicable?
It doesn't have to be necessarily a 40-hour work week. It looks at the kind of all hours over the whole year. It doesn't have to be, you have to have worked a certain amount of hours every single week. Oh, okay. Okay, so here's yes, as James, maybe I misunderstood the question. If you work a standard 9 to 5, 40, job, 40-hour work week, yes, if you're also doing real estate on the side, if you will, or all day, every day over the weekends, or yes, you can, as long as you meet the tests, you can qualify for this material participation or active participation or real estate professional. So I could be an accountant and also a real estate professional, as long as I meet the tests.
And what are the new rules for registering the LLC?
Do you mean the Corporate Transparency Act? Sure. Registering so there is a new, it's not, the IRS didn't come out with this, it's, I think it's the FinCEN, financial crimes, something like it. But the Corporate Transparency Act, it might be what they're asking about. It's new legislation. We are advising clients to speak with their attorney on that, with getting their LLC in compliance with the laws as regards to registering the LLC, the deadline for registering it, whether the LLC is brand new or has been in existence for many years. The owners, the number of owners involved, yes, we're advising clients to discuss this with their attorneys.
And please clarify, management office in personal residence.
A personal residence would be your home, your primary home, or your vacation home, something that you use yourself, you use personally. That would be separate from something where you have tenants full-time. That's strictly a resident, a rental property, but you have a second home, let's say a vacation home, where you're using it part of the time for personal reasons, for your own family vacation, and then the times that you're not there, you are renting it out, short-term rentals, or to, even longer term, or, longer leases, things like that. And then a management office, that's if you're, I hope I'm answering this correctly, but if you've engaged a management company to help oversee some, kind of like maybe like a Cushman Wakefield is a big name in the area. They're the ones who are kind of managing the day-to-day operations, or helping you with tenant complaints or overseeing repairs and maintenance. They're doing the bookkeeping for you, possibly. Hopefully that answers the management office question.
One bank account, usually with the managing LLC, all owned by you, but each property tracked separately and no co-mingling of accounts. Is that the easiest if we go?
I mean, that's certainly a good option. I think that's a good way to do it. We just recommend always keeping separate business from personal.
The federal government has new paperwork that's above and beyond initial state filing. All LLC must file new forms for 2024. My question is, what are they?
I think, again, that's probably the Corporate Transparency Act, which is new in 2024, or at least it's new for 2020. You have to file it by 2024, I would say. And again, we're just advising all clients to speak with their attorney on getting that paperwork filed, because it's typically the attorney who has helped them set up the LLC. So we're advising clients to discuss with their attorney.
Thank you.
Okay, lastly, here is my contact information. Should you have any questions, I do have a couple of business cards. Don't know that I brought enough for everyone, but myself, or even I didn't introduce Jane. She's here with me this evening from Anders. She's been helping answer some of these questions. Jane is one of our partners at Anders. She helps lead our real estate group. So as you have learned, a wealth of knowledge and experience. But yes, Jane is here with me as well, Jane Maddox. And then thank you so much for your time. Oh yes.
All right, that is everything we have for you all tonight. Appreciate all of the Q&A. I think this was especially informative as we look forward to tax season. So I've got a lot of work to do. All right, so we have the room for a while. Those online, I guess you guys can mingle for a while, but we'll be in the room. Looking forward to seeing you all next month and all of the months